Okay, we will start our program. I want to thank everyone for joining us today as Credit Risk Monitor presents 1 year in, the COVID-19 pandemic pushes financial risk to the limit. This is the first of a two-part webinar series. We will have our second part in 2 weeks. So at the end, you'll have a chance to register for the second part of this webinar series. The host for today's program will be Mike Flum, Credit Risk Monitor President and Chief Operating Officer. And our featured speaker today is Dr. Camilo Gomez, who is Credit Risk Monitor Senior Vice President of Data Science. Next slide, please. Our program is expected to last 1 hour in duration, with the final 15 minutes dedicated to Dr. Gomez and Mike answering questions from attendees. If you wish to submit a question, please use the Zoom raise hand option so we will know to remove mute, or if you prefer, you can also submit questions via the chat. During the program, we're also going to be conducting some quick polling, so please be on the lookout for a poll. If you would like to get in touch with our speakers after the conclusion of the webinar, we will also provide you their contact information upon request. So if afterwards you wanted to talk about something a little bit more in depth, you're more than welcome to. We'll get you in touch with Mike and or Camilo. Okay. Dr. Gomez and Mr. Flum will touch on various subjects, including but not limited to what makes Credit Risk Monitor unique in the market, what we know and how it impacts you, public credit risk models, how they compare and why the FRISK score is best in breed, and how COVID-19 impacted financial risk in 2020, risk and opportunity. As mentioned, Dr. Gomez will lead today's conversation. He is the architect of the Credit Risk Monitor FRISK score, which is a metric that provides the most accurate assessment of public company bankruptcy risk in the world today. He has decades worth of experience in data science to help financial professionals make educated decisions. Also speaking will be Credit Risk Monitor President and Chief Operating Officer Mike Flum. Mr. Flum is also a passionate advocate for data science and the doors that artificial intelligence is opening to help our clients make informed decisions about the sustainability of their portfolios. So without further ado, I'm going to kick it off to Mike, who is going to go over the next slide.
Thanks, Nick, and thanks everybody for joining us. We're definitely excited to be bringing you guys this content, and hopefully we're able to inform you about a little bit of what we do, as well as answer some of your questions. So I'm going to start off with just a generalized question, which is, have you been surprised at all by any bankruptcies in 2020? Feel free, Nick, to start the poll. You can answer this. We're going to let it run for a little while. But any specifics, related to maybe a sector, whether it was early on or whether it was not. And then obviously, I think these are one of the things that maybe is interesting as an aside, maybe get in contact with us afterwards. But we're always interested in hearing about, any of the post-mortem analysis that people do, kind of looking at, what actually occurred. It's one of the things we focus on a lot when we do our bankruptcy case studies, because we think it's really important way of understanding kind of how to prepare yourself for future cases. Obviously, not to say that history, consistently repeats itself, but it's certainly a slant rhyme. So we definitely like to evaluate what worked, what didn't, and hopefully that can be one of those things that gives you some key indicators to look at going forward. So let this run for another 10 seconds so far.
Interesting feedback here. The poll will end now, and I'm about to share the results. So it looks like 62% no, 24% yes, and 14% not sure.
All right, well, that certainly gives us some indication. Obviously, some of you were. It's good to hear that most of you weren't surprised by one. Hopefully, you weren't actually affected by one at all. But if you were affected, at least you had the chance to kind of take some steps to mitigate your losses or possible bad debts. So with that, why don't we kick off into the heart of this? And Camilo, I'll let you kick it.
Okay, so, what makes us unique? Well, one of the things is that we've developed a set of analytics that are fairly strong. And the table at the top here shows the performance of the FRISK score, which is our central piece of analytics, and its high effectiveness in identifying and providing early warning, at least 3 months before actual bankruptcy filings take place. As you can see here from the table, in the US, we were able to provide early warning on 98% of bankruptcies, and in worldwide, it's a little lower, 96%. The coverage that we provide, it's, more of it is focused on public companies, but just that alone basically covers 81% of the world GDP. We've made significant investments, and we continue to do so, in identifying unique sources of data for looking at the financial risk of companies. And we make a great deal of leverage of machine learning algorithms. And the reason for these is that they learn, it gives us a lot of tools just besides the simple linear regression models in understanding the nonlinear relationship between different data items and the target. And the target here typically is bankruptcy, because from a commercial credit perspective, that's probably the most significant event that can happen to a creditor when a client of theirs goes and files for bankruptcy protection. So these types of techniques are very good at identifying the nature between these multiple sources of data. Next.
Yeah, and I'm just going to highlight, obviously, these links will be live for you guys when you get the deck, but we do have some, predicting bankruptcies and our essentially our accuracy in doing so. You can really get into the weeds, so feel free to check those out. All right.
So, what do we know that others don't? Well, there's 5 key items here. One is that 25% of all corporate debt is trade credit. It's 3 times as large as bank loans to corporations. And public companies, even though numerically they're a much smaller group than private companies, they represent the lion's share of this space. Credit managers, which are a big part of our client base, are essentially gatekeepers. And in taking, making determinations on how much credit to extend to a client, they have a huge impact on the working capital of that client. And so they're a really important group that use our service. And so it has a meaningful impact. And we at CreditRiskMonitor, because of the service we provide and the way we provide it, gives us special insight in the aggregate behavior of this group of individuals. So,
yeah, and just to add on to that too, I mean, I think it's one of those things that gets a little bit downplayed within the news. Certainly, you don't really hear about credit managers being, so important in these markets, and it's really, a dereliction of responsibility, because, as Camilla was saying, I mean, credit managers are a huge component as far as the working capital liquidity of many B2B, transactions, as well as businesses in general. And you don't really hear about it very often. But, if credit managers in aggregate decide to cut terms or to reduce the credit lines to many of these businesses, they're kind of put into a weird situation where they're going to have to go and get outside financing, whether it be from banks or from hedge funds. And as we all know, trade credit comes with 0 interest, interest free. In fact, in many cases, it can even come with a discount within like the 210 net 30 segment, right? You're actually willing to give a 2% discount for quick payment. That doesn't really exist within, non-trade credit financing. And typically when this stuff is happening, these businesses are already showing signs of distress, which, tends to indicate that not only you're not going to get the, low interest rate, but you're likely going to get a pretty high interest rate, possibly, getting towards usury levels. So, if you're in that situation, that's the kind of thing that can make or break your liquidity. So it's one of the reasons we factor it so much into our FRISK score as far as the crowdsourcing, because truly that aggregate behavior is indicative of whether or not you really have a risk of going bankrupt, not in necessarily the long term, but much more in the short term. So I think it's really important.
Yeah, we'll show later on the importance of the aggregate click behavior for that we include in our service. If we could have the next slide. So, the analysis of public company credit has been around for a long time. And the types of models generally fall into two broad categories. What are typically called through the cycle models, and ratings are an example of that. And there, what you try to do is you try to rank the companies from the best credit quality to the worst credit quality, but doing it in such a way that is independent of where you are in the credit cycle, so that when you're from the best part of the cycle or the bottom of the cycle, the ranking of the companies that you provide stays basically the same. Point in time analysis, on the other hand, recognizes the fact that we have a credit cycle, and different companies may be affected differently depending on whether you are at the top of the credit cycle or the bottom of the credit cycle. And our FRISK score really falls into that category. And these types of models tend to be shorter term. Ours is 12 months, while through the cycle model may have a much longer term, much more appropriate for bond investing, which might be looking at 5-10 years down the line. The types of data that are used in these models really are a broad range. Most common is financial data only models. And of course, this is the type of information that as a credit analyst tends to look at to evaluate the health of a company. These are driven by financial statements, and so they're only available on a quarterly basis. But they're very informative. However, they don't respond as quickly to changes in the credit cycle or in market conditions. A newer type of credit model is stock market-based models, and the FRISK score makes use of this. KMV's, Moody's KMV's model is also based on this, and this goes back to work done back in the 70s by a fellow by the name of Robert Merton, who recognized that there's a relationship between the share price of a company, its trend, its volatility, and the underlying health and ultimately credit risk of that company. And the advantage here, of course, is that these are available on a daily basis. In fact, it could be even intraday, but we don't find that to be as meaningful. The third type of model is similar to the stock market data, except rather than looking at stock market information, it looks at bond spreads, which in some ways are much more closely related to credit risk, since that's what they're trying to price. There's several products out in the marketplace, mostly on the investment side, that look at the bond and CDS spreads of companies. These also frequently update. However, the universe isn't as big as for the traded stocks. The fourth type are, of course, agency ratings. And now, agency ratings are typically developed for bonds because it's usually the companies, the bond issuer, that hires the rating agencies to provide a rating on the bond they're looking to issue. But we find them to be very useful in predicting bankruptcy as well, as they apply to commercial credit. The next type of model, what are called macro models, look at the broad economic conditions of an economy, of a sector, and using that information tries to look forward and predict the overall level of bankruptcy rates going forward over a period of time. Not necessarily on any specific company, but just tries to see whether the conditions that we're entering have a higher risk of bankruptcies than at other times. And the last type is payment-driven models, which are very popular and very commonly used in the commercial credit space. And they basically are driven off the payment behavior of companies. And the idea here, of course, is that as companies get into financial distress, they're going to try to stretch out their payments to their creditors to try to, preserve working capital more. And that can become a signal for the potential of financial distress. The cloaking effect, which Mike, if you want to discuss that, is related to how that applies to public companies.
Yeah, so I think, when you talk about the cloaking effect, obviously for payment scores, it's important, and it's pretty much the only thing you can use in many cases for private companies, because there aren't some of these other factors like financial data or stock market, certainly in many cases ratings. So you're using kind of a combination of macro as well as payments. In comparison with public companies where this other information is available, there's significant effect or significant evidence of this cloaking effect, which was actually coined by Dun & Bradstreet back in 2012, because the Paydex score, which many of you guys are probably familiar with, which is a payment score looking at the average payment delinquency potential. What they were finding was that for public companies, they actually weren't necessarily signaling distress at that particular point, and many people kind of got stuck during the Great Recession with a bankruptcy when the payment information was not really indicating any higher elevation of risk. And the reason being that public companies have access to capital markets. If you ever attended any of our other webinars, I'm sure you probably heard this before, but you can go out, you can issue stock to increase liquidity and use that to end up paying back your vendors. You can also go ahead and issue debt, and that's something that isn't necessarily available, or in the past wasn't as available for private companies. So I think it's important to also think about this from the standpoint of the CFOs. Not to say that credit managers are really doing battle with CFOs, because I think it's a much more of a collaborative, relationship with your customers. But to the same extent, CFOs definitely know that payment information is used a lot in credit decisioning, and it's also used by the investors as far as making determinations about whether or not a particular business might have elevated risk. And so the fact that it is used and that it is factored means that they have an incentive to make sure that they don't send that negative signal out into the market. And from that perspective, they do what they can to kind of manage that cash conversion cycle, make sure that they're managing their payments. And because of that, you can end up in these situations where you're getting a false sense of security. So for public companies, we definitely would suggest not necessarily using payment information as your main factor. Certainly something to look at so you can understand holistically, 360-degree view of your customers. But if you're going to rely on payments for publics, there's a chance you're going to get burned. We'll keep going.
So how do the models compare? As you can see here, we're showing three types of models. A FRISK score, and it has an accuracy rate of 96%. Again, its accuracy here is measuring that it indicated a high-risk situation at least 3 months ahead of a bankruptcy taking place. And the difference between the three types of models is the type of data that they use. In the FRISK score, you see that there's actually a broad category of data being incorporated, and that's really its main advantage, why it performs so much better than the alternatives. One of the things you see it doesn't use, as Mike was pointing out, is trade payments. That is not something we incorporate in evaluating the credit risk of public companies. Now, that doesn't mean you should look at it, because it tells you something about how they tend to pay. But just because they're paying well doesn't mean that they're not in financial distress. So the FRISK score, and we'll go into more details in the next slides, uses financial statement information, stock market data, basically, bond agency ratings, and subscriber crowdsourcing. Our subscribers, we aggregate and anonymize their behavior on specific companies, and from that we interpret their sense of concern about these companies. And we combine all of these things using artificial intelligence techniques. And that's a key component, because the relative weight of each of these data items can vary over time depending where you are on the cycle. For example, if you're in a very volatile period, the stock market data will be important in driving the credit aspects of a company. If we're in a fairly quiescent period, it will be the other pieces of data, the financial statements, bond agency ratings, that will have a bigger impact. So the weights kind of, this allows us to adjust the weights, or the system adjusts the weights as a function of where we are on the credit cycle. The payment scores basically are purely driven by payment. They might use some other things like tax filings and things like that, but they're typically available only monthly rather than daily for the case of the FRISK score. And the financial scores, like the Z-score, only use financial statement data. They're available quarterly only when financials tend to be reported. Next. So here we're showing the relative timings of these various approaches. And here I'm using the FRISK score and the Z-score as examples of this. And the x-axis here is time, mostly in 2020, showing the impact of the COVID crisis on credit. The solid red line shows the number of companies as a function of time that have classified as being high risk. And you see that basically at the start of the year in March 2020, there's a rapid rise going up to a peak within that month, basically. And then it starts to go down, and goes down basically around June. It hits a level, and then it continues going down at a slightly lower rate. For comparison, the red dotted line, that is the Z-score. That is the number of companies that are classified as high risk by the Z double prime score, and it is driven by financial statement information. And as you can see, it actually stays pretty flat. There's a little sawtooth steps, and that has to do when financials are reported. You get a small change in that, but you don't see a big reaction here. And the green bars, that is the number of bankruptcy filings per month as a function of time. These are not all the ones. These are the ones we're tracking, and these are significant bankruptcies. And you can see basically that they started increasing soon after March, and they hit a peak in June, 3 months after the jump in the FRISK score. So this is what we mean by providing an early warning, giving you enough time to look at your portfolio and be able to take action on the weakest members of your credit portfolio. But not only did the FRISK score jump quickly to indicate an increase in risk, after it hit that peak, it's actually started going down, and it's continued going down, and it's almost at the pre-COVID level at the end here. And that is consistent actually with the evolution that we've seen in bankruptcies. We see that bankruptcies peaked in June of last year, and after that they've been coming down, and that's reflective of the massive amount of intervention that governments have had to stave off bankruptcies. It has increased the amount of debt that these companies are taking on, but in terms of bankruptcy filings and by extension, their ability to make credit payments, commercial credit payments, that's been extended. Now, early in the crisis, a lot of credit analysts thought that, this was going to be a significant impact, and it has been. The number of bankruptcies, as you'll see later on, is comparable to the 2008 crisis. But they expected it to be much worse, and it hasn't been. In terms of public bankruptcies or large bankruptcies, there has been an increase, but it has turned out to be a little bit better than was anticipated before. But the FRISK score now is showing you both the downside, and it's also showing you, well, things are starting to improve. If we could have that next.
That symmetry is really key to this. You want a signal that's both going to give you that early warning on negative feedback, but also to give you, the ability to kind of make those determinations on when it's time to maybe open up credit again. And this is one of those key factors of the FRISK is that it really is that symmetric score.
Mhm. So next, I'd like to cover the different components of the FRISK score. And if we could have the next slide. So why is the stock market important in evaluating credit risk? And the idea is really simple. Common shareholders are the last ones to get paid, and so they are very, very keenly aware on the financial health of the companies they have an investment in, and based on that determination, they decide to either increase their exposure or drop their exposure to different companies. And that's the fundamental reason why it is. And Robert Merton's insight back in the 70s was that we can use that information to look at the relationship between the assets and the liabilities of a company. The assets values and the liability values you see in financial statements are only an approximation. They're a point in time, and they're necessary approximations that are made to produce a number that you end up seeing in the statements. Merton's realization, of course, is that both of these items are actually volatile over time. They change because of the changing market conditions, competitive kind of situations, events that may happen to a company. And he realized that the assets, are a volatile feature of companies, as well as the liabilities, although not as much. And so he developed a formulation by which we can re-estimate the asset values of companies as a function of their market equity, in terms of their volatility, in terms of their absolute value, in terms of their trend. And so with that, he developed a structure to project, given the current set of values for assets and liabilities, what is the likelihood that at some point in time, the asset values of a company are going to fall below a certain threshold that's determined by the liabilities of the company. Because at that point, the business is technically insolvent, because if you were to sell the business, you would not have enough to cover all the liabilities of the company. And that's the key idea here in this structural approach of Merton's, that it takes into account the relationship between the assets and the volatilities. And within the FRISK score, we have implemented this idea in determining a factor called the distance to bankruptcy, which says that if a given, the higher the distance is, the less likely a company is going to be in financial insolvency over a period of time. And in the FRISK score, we look at 12 months. If we can go to the
next one thing to add to that too, just to give a little more color as a practitioner, when you start talking about book versus market value of equity, which is really what Merton's insight here was, is that you can essentially use the market value of the equity as a way of approximating the asset values, given the accounting equation. But I think it's important to discuss things like, for instance, if you have a high market value, that gives you optionality and liquidity that isn't available to other businesses. So if you're getting close to that book value of your equity from the accounting side, you can't do things like a PIPE, which is a private investment in public equity. You can't go to an outside hedge fund or maybe even a bank and manage to sell out some shares without diluting the actual value of your business. So having a higher stock price, is really key as far as bankruptcy protection, because it gives you that ability to kind of control your liquidity function a little bit better. But with that, let's keep going.
So the trade-offs in the Merton model are, the advantages, of course, is that it's stock market driven, so it's forward-looking. It captures behavior that is not necessarily reflected in financial statements yet. It helps resolve the impact of news stories. You might see a news story that you might interpret as being very negative on a company, and yet it doesn't seem to have an effect on the share price. And that's because A, the market has determined that it may not be such a bad thing, or it's already been priced in. Next one, very importantly, the stock market is very good at incorporating industry effects between different industries. And that's something that if you're developing a financial ratio model, you have to customize that because different industries have different aspects and how the different financial ratios impact their behavior. The stock market is very good at this. And then one of the major advantages, of course, is that this is updated daily. We calculate our FRISK score every night based on the closing share price of companies that we track and publish those the next day. The disadvantage, of course, is that it's limited to publicly traded businesses, which is a small section of the overall commercial space, but it's the lion's share of even trade credit. And it can be impacted by broad stock market movements that may not be related to specific businesses. And basically, there isn't anyone else in the commercial credit space. KMB does sell into this, but they're at a different price point than we are. But we're pretty much the only ones using this type of approach in this space.
Yeah, and it's also targeting default, exactly like a typical Merton model. You know, KMV is not on bankruptcy. So we really take that seriously because that's, as a credit manager, that's really what you're concerned about. You want to be selling into somebody, you know, as long as you possibly can.
Next. So financial statements, you know, these types of models are what are called empirical models. They're trained on a target and you try to adjust the weights of the different inputs so as to optimize the prediction of the target, in this case, bankruptcy. Within the FRISK score, we use actually the same ratios as the Altman Z-score. We went through and examined a number of them and we found them to be very predictive. However, we have added ratios related to the income statement and the cash flow statements, which are underweighted in the ratios of the Z-score. And we basically recalculated. We don't explicitly use the Z-score itself. We use the ratios, and we've optimized their relative weighting in relation to all the other data that we use in the FRISK score to incorporate these sets of ratios. Next. So in terms of advantages, well, you know, it uses data that everybody's familiar with, and you know, credit analysts are trained on this, and so the ratios are familiar. And one important advantage, of course, is that this type of information adds stability to the FRISK score. It compensates for the more volatile aspects of using stock market information alone. The disadvantages is that it is quarterly. And it can significantly lag critical events because you got to wait till the next financial statement is available. And even then, those are reported even with a lag. So the lag can be quite significant. Next. Agency ratings, you know, these are typically issued for bond default risk. However, we find that they're very predictive for bankruptcy. And one of the main advantages, of course, is that agency ratings can reflect information that is not publicly available because they're hired by the bond issuer to issue a rating on the bond, and they will share financial information that they may not have disclosed to the public yet. They're typically issued by committee, and the advantage of that is that it ensures consistency across the board, across the different segments that they issue ratings for. The type of factors that they include are, you know, they look at cash. Cash is king. If there's enough cash in the company's balance sheet, they know that the risk of immediate insolvency is not very high. They also look at the financial flexibility. What other sources of capital or funding that a company has available to it to help mitigate the risk of default. And they look at the financial or the business environment the company is in, the competitive environment. We find that even though they're been for bond defaults, they're very good for bankruptcy. And internally in the FRISK score, we've calibrated agency risk ratings to the risk of bankruptcy rather than default. And that's what we end up using. We could have the next slide. The advantages for agency ratings, of course, is that the consistency. A AAA in one industry is equivalent risk to a AAA in a second industry. They can reflect non-financial information, as was said before. The disadvantage, of course, is that it's a very limited universe of companies that have public debt. They're reviewed infrequently because they're a committee. They have to call the committee together and have a committee meeting. And so it's only a couple of times a year that they're able to either reaffirm the current rating or change the rating. And because of that, of course, the ratings themselves may not reflect current conditions. That can, especially in volatile markets, it can significantly move before the agencies are able to get to a particular company and revise the rating as necessary. Next. One of the unique features of the FRISK score is the crowdsourcing effect. And there's two main components. One is the nature of our clients, credit managers, you guys. You're gatekeepers to the health and have a significant impact on the financial stability of the clients that you work with. And the other one is the way we provide information. So suppose you're evaluating, let's say, IBM. Okay, so you typically go to the snapshot page, which is the first landing page that you see, and it gives you a summary of what the company does. It gives you the FRISK score. It gives you any payment information. It gives you any ratings we might have on the company, and based on that data, you may decide that this is a very low risk. I'm going to go to the next one that I need to go review, or you might be inherently concerned about a specific company. And in that case, then you start to go down the tree that you see here. Look at the stock market performance of the company. Look at the company news to see if there's any new news that has been reported. Look at the details of what the FRISK score or what Moody's ratings are implying about the company. Look at the different financial statements and over time. We capture all those clicks. And what we do is we aggregate them and anonymize them. And so we can look at how a group of credit managers that are dealing with a specific company, what their sentiment is as it regards to that company based on their clicks. The more we see people going down the tree to examine in more detail a lot of the rich information that we provide about companies, the more the significance of that behavior becomes. And we find that there's a real lift in the FRISK score performance, as we'll see in the next slide. If we can have that, please. On the graph on the right shows the difference between running the FRISK score without click data, the gray bar, and running it with click data, the yellow bar. And the FRISK score goes from 1 to 10, 1 being the highest risk, 10 being the lowest risk. Here we're just showing you the red zone, which goes from 1 to 5. And you see that the biggest difference are in the 1 and 2 categories. Without the FRISK score, FRISK 1 usually captures about 35% of all bankruptcies. That jumps up to 50% basically with the clicks data. FRISK 2 and 1, because this is a cumulative, captures 50%, and that jumps to 67%. And the difference comes in is that by using the click information, companies that had a higher FRISK score without that get migrated down because they are higher risk into the 1 and 2 categories. As you see, as you go up in FRISK value, you see the difference between the two get smaller and smaller. And when you get to the blue and green, there's almost no difference there. So we see that there's a real value, and it's in that gray area because it's the 4, 5, 6, and to some extent 7 that has the largest impact and rearranges the perspective of or the calculation of the scores towards the higher risk bucket.
Yeah, and again, this is another instance of kind of explaining exactly why credit managers are so important, is because this is showing you that what we found is that it was independently predictive, those aggregate research behaviors. That's why we factored it in, and it gets back to that exact point, which is when people are really in distress, if they have their their credit or their trade credit cut off, it pushes them into a completely different risk category, and so this is really what we're identifying here. Again, not to aggrandolize the credit manager too much, but you guys are really key in terms of the liquidity function for most of these businesses.
So in terms of the impact of COVID-19 on credit, if we can have the next slide. Here we're showing the number of bankruptcies for North America and Europe as a function of time. And you can see that between 2019 and 2020, the US showed a significant increase in bankruptcies, almost comparable to the bankruptcies in the global financial crisis. Europe, interestingly, doesn't show much of an increase. And in both cases, I mean, that's reflective of the fact that there was, massive government intervention, just as there were back in 2009, that prevented many companies from failing. And one of the things we've seen, of course, is that, the growth of zombie firms has been quite significant. And so we feel that we're undercounting, especially in Europe, the number of bankruptcies. Now, the COVID crisis hasn't impacted industries in the same way. And in fact, in the next slide, we show a service, what we call the FRISK Stress Index, which aggregates the risk associated with either a portfolio of companies. If you're using our service, we can calculate the stress index on your portfolio, or we can aggregate it by sector or industry for different countries. Here we're showing you the air transportation sector for all countries. And as you can see, it jumped up, the risk level, it jumped up quite a bit at the beginning of the COVID crisis. And it hit a peak towards the middle to the late of last year, and then started coming back down again. And it's reflecting of the fact that, people are expecting that air travel will start to rebound going forward. But this is an industry that has severely impacted. And so this is by using this tool, you can see which industries are affected more or less. As in the next slide is an industry that was actually may have benefited, if anything, from the COVID crisis. It was very, slightly impacted at the beginning, and then it dropped significantly after that. And it's now well below actually the risk level it had even back in the financial crisis of 2008 and 2009. So by using a tool like this, you can identify clients that are in high risk situations versus those that are in lower risk situations.
Yeah, and it's important to note, I mean, this is one of those situations where this can actually function both as, a portfolio level tool, like Camilla was saying, or obviously on an all business level. But you have this ability to move around particular industries as well as geographies. So this is actually an aggregate way of almost getting at some of those macro models that Camilla was talking about prior, except you're leveraging the accuracy of the FRISK score in doing so. And I'm just going to highlight in that upper right corner, kind of above the graph, you can see that company list. You as a user can click in on that link right there and actually see all of the companies that are in that portfolio or that group. So pretty interesting way of then digging in. I'm going to talk a little bit about the global debt problem because if any of you have ever been on any of our other webinars, we talk about this a lot. But for those that haven't seen this graph, there's obviously a correlation between non-financial corporate debt relative to GDP and delinquency and default within corporate bonds, as well as within actual bankruptcy. So you can see that in terms of the peaks. They overlay in almost all of these cases. Obviously, this surge in non-financial corporate debt relative to GDP over the last year has been dramatic, and that's reflective of the fact that you've seen record issuance of corporate debt, non-financial corporate debt, as well as a decline in GDP. We've since seen that start to come a little bit back into terms, but just for reference, in 2020, high yield or junk corporate debt issuance was approximately $435 billion, which beat the previous record by almost $100 billion. On top of that, investment grade debt issued was nearly $2 trillion. And that's significant because a really, really large portion of the investment grade debt currently is rated at the BBB category, which is just one notch above really this junk debt. So I think right now B2B makes up well over more than half. Back in 19, it was actually about 53%. I would reference now, I think it's closer to 55 to 56%. So it's really significant. The other thing I'm going to point out is, it's kind of interesting. Camilla was talking about it, but at least in 2020, we saw that the companies that were affected by bankruptcy in Chapter 11 tended to be on the larger side, which is a little bit of a departure from your typical crisis, especially given the fact that typically in crises you don't see a larger issuance of debt. Those two things really have never occurred, at least in the last 50 years. But 60 firms filed for bankruptcy, all with over $1 billion in assets, which is the highest level we've seen in the last 30 years, and beat out the global financial crisis heart of 2009 by over 11. So pretty dramatic effects there. And that's important because obviously, tend to have bigger balances with bigger firms. So if you're going to get hit with a bad debt, it's probably going to be larger at those large businesses. So we get over to Camilo on the interest rate side.
So here's to provide a historical perspective of where interest rates have been and where they are now. And so here, the blue curve is the 10-year Treasury rates going back to 1950. And as you can see, of course, rates hit a peak in 1981 at a high of 15% per year for the 10-year notes. And this was at the peak, of course, where there was massive inflation. Since then, they've been coming down pretty much monotonically without any cessation. I mean, there's been jumping around. And they are an all-time low back in 2020, July of 2020, just a little bit over 0.5%. During that time, and you can see, of course, in the green line, this is the fraction of non-financial corporate debt that's been issued. And you can see that there's a real break in the slope right at the point where interest rates start to come down, and it's grown very quickly, monotonically increasing during that same time with this. And so the question you have to ask yourself is, how much room is there for rates to come down any further? Our view is that, well, there isn't much more. And, it may stay low for a while, but eventually it has to come back up. And what will be the impact on all that debt that is outstanding when the servicing cost of that debt starts to increase as rates increase? And so the tools we're providing can help you with that, Mike.
Yeah, as Jerry also likes to say, aside from obviously, don't learn to shoot your rifle while you're being shot at. Interest rates also are the natural predator of some of this debt issuance. So, the higher the interest rate, the less prevalent issuance is going to be. So I think it's interesting to kind of see that really in that graph that Camilla was putting out there. But to this quote over here, I think that's kind of important because, at the end of the day, it's the right time to be preparing your processes and, getting your systematics together in terms of how you're going to respond is prior to you having to actually respond. You want to make sure that those processes are well laid out, clear, you have your service models together. So this is really an interesting wake-up call because, as we saw in that poll, not everybody was affected by something that surprised them, right? And that's great, and I'm really happy that most people weren't. But to the same degree, this is when you kind of get that bell ring to say, hey, we really should kind of figure this out and make sure that we're set for the next potential time, especially with what we just showed on the interest rate factor, because if those start to come up in inflation, which I think all of us have certainly heard in the news recently, I think that's a really big risk. Just as an aside, I recently heard that I think at this point, the Bank of Canada now owns approximately 40% of all Canadian bonds. So just to give you like a reference point for that, that's massive crowd out. That's really, that's a signal of massive inflation. I think we really need to be prepared of that because there's been so much issuance of public debt over this past pandemic. It's actually larger than what was put out during the great financial crisis. So kind of an interesting to put out there, but I think what we've kind of summarized for you guys here is that the FRISK score and our tools can be used both as an opportunity factor where you can find things that are going to be helpful in terms of maybe turning up your credit risk or expanding your credit terms because you have companies that really, are deserving of that in these particular situations, making the best of an opportunity, as well as kind of giving you that early signal, for things as far as risk related to cut back and, maybe tighten your policies. So, we obviously like to talk with clients all the time, help them out as much as we can. So if you do have any, specific questions, we would definitely love to handle that. and work with you as best we can. And with that, I'll kick it over to questions.
Yeah, I think we overachieved a little bit. We were able to answer a lot of them during the course of the program, but I think we still have one that just came in regarding stock buybacks. I don't know if you want to handle that, Mike.
Yeah, Mike, you want to, that's more into your bailiwick.
Yeah, well, I mean, obviously, we all have kind of heard that a lot of the recent issuance was put for buybacks. I mean, obviously, in comparison, you've seen record levels of debt, and not very much of it has been put towards new capital expenditure. I would say, you know, in general, I don't really have the actual amounts there, but I would say it's pretty significant. And you can kind of see that because in my mind, really what I believe is going on here, if you look at the market, the inflation that we all think should have been hitting during all of these periods hasn't necessarily hit in, you know, the places we're used to seeing it, whether it be energy, whether it be food, things like that. I mean, obviously in the last couple months, it's been in food a little bit more so than we thought. But when you look at the stock market in comparison, we're hitting record highs all the time. So I would actually go to say that the you know, the issuance of inflation is really actually reflected in the stock market here as you get to valuation levels that are just absurd on the PE basis. You know, when was the last time you ever saw that happening where you actually have firms that are cutting their earnings you know, guidance and their stock market is going further up? I mean, again, that's an indication related to you know, related to the fact that interest rates tend to be the determinant of that. But you know, I think it's also important to say that buybacks are always going to factor, you know, towards the stockholders rather than the trade creditors. You know, essentially that's a way of eroding out the bottom of that corporate finance pyramid. So the smaller the equity block, you know, the worse it is for trade creditors. It's certainly something to keep in mind.
Guys, I'm going to open up the line. We do have an actual hand raiser that wants to, you know, lend their voice. So I'm opening up for NBK2JXZ. Hell of a name you got there, but please ask your question. You should be open. Well, we'll just mute you for now for a second. We do have another question from Patrick Kotarek. So I'll open it up to Patrick.
Maybe we should read some of the questions because there's some that I'd like to address here. Somebody was asking about the 96% effectiveness, and I'd like to, and Mike answered some of that. I'd like to just add a little more flavor to that. You know, we think of the FRISK score as kind of a flow management tool, basically. You know, if you think about the average risk of bankruptcy for public companies, it's only really 1% on average. Now, a FRISK 1 has about a 20% risk of bankruptcy. So that means that 1 in 5 actually ends up filing for bankruptcy. Now, the actual percentage of companies that are in financial distress is actually much higher than that. But if you look at the number of companies that fall into the red category, between 1 and 5, that's somewhere between 20 to 30% of the universe of companies. So that means that 70 to 80% of the other companies that you're dealing with are well above that and are probably, you know, lower priorities for you to handle. And so that's what we mean by the flow rate. The 96% means of the ones who actually did, how many were actually in the red zone and identified as high risk.
We still seem to be having a little bit of problem with audio. If we're asking you guys to unmute, you're allowed to unmute your mics. We also have a question from, I believe this is Paul Claflin. And Paul's asking, is there concern that valuations and share movement is impacting the FRISK incorrectly?
Yeah, that's one of the things where the other factors do come in. And so we take into account, you know, the financial condition as reported by the financial statements and agency ratings. And so that those tend to mitigate a lot of the exuberance that might be exhibited by the stock market piece.
And NBK2JXZ's question now has been submitted in writing. Do you guys think that various governments would or may artificially keep interest rates low to help pay for all this recently issued debt?
Mike, you want to take that?
Yeah, I mean, well, certainly I think it's in everybody's best interest as far as governments to keep interest rates as low as possible, right? I mean, that's what we've seen over this past period. That's kind of the entire basis of modern monetary theory is that, you can constantly just keep issuing more debt. I tend to, maybe I was just raised differently, but, the idea of just getting money for nothing doesn't really sit well with me. So when I think about debt, I like to think about it in terms of really pulling forward future purchases into the present. And, if you were to take that maybe to an individual level, if you're, talking about buying a refrigerator and you decide to replace your refrigerator before it's really, hitting the wall as far as its utility, I don't think that you can continue to keep doing that cycle over and over again without being, essentially pulling too many purchases out of the future. So I think, obviously, I think governments will go ahead and try and do that as long as they can. But eventually you do see these effects. I mean, look at what's happened with the Bank of Japan. They've essentially had 30 years of non-growth because of that. And when you get into some of these factors, you can look at the change in terms of GDP attributable to each dollar of debt. Pretty much it used to be that there was an actual money multiplier effect right now, or in the past. I think right now, the most recent figure I saw was that you have to issue, each dollar of new debt that we issue contributes less than 25 cents towards GDP. So, there is a runway here where that doesn't work in the future. You can't just keep financing everything on debt purchases because the value of that debt in terms of its actual effect to GDP actually starts to run out. The crowd out effect, to be fair. I don't know if that's.
So we have all right. We have a question from Beata, and I think this is more so towards Camillo, because I know you've run the FRISK on certain private companies. How applicable is FRISK for private companies versus, obviously publics?
If we have financial statements on the private companies, we provide a FRISK score, and we find it to be effective. Obviously, because the FRISK score uses so many different data items, the accuracy drops, but it is still very effective.
Okay, we have a question from Danilo. Does the FRISK score assumption change based on industry in terms of the weights of profitability, liquidity, and probability ratios? Capital-intensive companies are very different than tech companies, as an example, from multiples and ratios perspectives. And again, that's just Danilo's example.
Yeah, that's exactly right. And that was the point I was trying to make earlier. And I apologize for that. But no, the FRISK score actually is a single it's a single model, but it adjusts for the different industries. And it does that through the equity or the stock market component, because we find that the stock market treats businesses in different industries differently, and it captures that differentiation. So it doesn't force us to adjust the financial ratio components for those businesses as much as we would if we were to use a pure financial ratio model.
Got it. So we probably have time for one more question. We are coming up at against the top of the hour. So Paul, again, submitted a really good question. Various business publications are predicting a sharp increase in commercial bankruptcy in the back half of 2021. What are our general thoughts on that?
Well, I'll start. Camille, you can jump in whenever you want. I look at it in terms of, if businesses were essentially keeping themselves afloat based on, public money that was issued, and potentially there's resurgence of anything, I would tend to think, I think a lot of this stuff will hit a runway. To the same extent, when you look at this debt bubble, I think that's why we've been talking about it for so long. Across the board, you just have so much debt out there, without a whole lot of major GDP growth. It's been a long time since any real economy other than China was growing at more than 3 or 4%, really. So I just kind of look at that and say the comeuppance is always there, right? You can't continue to just flood the market with debt without having the capacity for downturn. So I would definitely echo that statement. Mil, I don't know if you
I mean,
feel
it
differently.
depends on how quickly interest rates start to increase and how much intervention the government continues doing. If you look at the scores right now in the market, it's been in a tear. The stock market has been in a tear since actually since March. And so, yeah, you have to ask yourself that, is it reflecting exuberance, or is it reflecting the fact that the government has massively intervened in the market and pumped $5 trillion of cash into the U.S. economy? And where's that money going to go? In fact, Jamie Dimon was just talking about that, I think, in today's journal, how the impact of all that cash is going to have in the next 6 months or so. So it's a good question, and it may be that bankruptcies do increase, but they may increase slowly.
Well, with that, we want to thank Camilo and Mike for leading the conversation here today. A final note for all attendees, this is just the first part of a two-part series with 1 year in. You can see the slide on the screen right now. We will be having another session exactly 2 weeks from today. Same time, same day, Wednesday at noon, but this will be on April 21st. And the featured speaker will still have Mike in tow, but we'll also be introducing Chris Chach, who is our VP of Client Services. And he's going to look at the impact of COVID-19, particularly from how our clients have rolled with the punches, have really sort of worked harder and smarter at the same time in terms of adjusting the way that they use our tools, our alerts, our subscriber portal in and of itself, and talk about some of the offerings that they may not be leveraging right now, such as trade contribution, and why it's really important on a go-forward basis in terms of their subscription. So if you guys can, there is, when we distribute the deck, we'll be distributing an annotated deck and a replay of the webinar. There is a link to register for the next webinar in 2 weeks. If you do have the time, we highly suggest it. And with that, we want to bid everyone a farewell and thank you for attending.
Thanks, everybody.
So on.